So picture this, mortgage rates in the low 5% range. It's not just wishful thinking. This could actually happen. And here are the top 5 reasons rates might move lower in 2025 and exactly what we need to take place to get us there. So reason number 1, inflation needs to stay near the 2% level. So inflation is the single most important factor in driving mortgage rates and interest rates. When inflation is under control, rates tend to be lower. The Federal Reserve goal is 2%. They've talked about this, and the target is 2%. And if we stay around that level, lenders will have confidence in stable, predictable returns, leading to lower mortgage rates. What needs to happen? Continue control of energy prices, so oil and gas, improve global supply chains, and balanced wage growth. If we get too much wage growth and people are making more money, that can be inflationary. Reason number 2 is the 10-year treasury drops. So the 10-year treasury yield is a foundation for mortgage rates. As it falls, so does borrowing cost for home buyers. Morgan Stanley recently predicted that the yield could drop to 3.5% by late 2025. Historically, mortgage rates move in tandem with the 10-year treasury, which could bring us to the low 5% range. What needs to happen? A combination of steady U.S. economic growth, strong global demand for treasuries, and controlled inflation. Inflation is the key. And then reason number 3, the Fed lowers short-term rates. This is what we've been hearing about. And I think the takeaway is it's not just in control of the Fed. Okay. The Fed can lower rates. And as we've seen, mortgage rates have actually moved higher in the near term. So the Federal Reserve's decision on short-term interest rates will send ripple effects through the economy, impacting long-term rates like mortgages, auto loans, etc. If the Fed cuts rates to combat slower economic growth or lower inflation, it creates a steeper yield curve, which could actually lower long-term borrowing costs. Keep in mind, the Fed does not control mortgage rates. When they lower the Fed funds rate, that is the rate that banks lend to get charged to lend money overnight. What needs to happen? A soft landing for the economy and continued progress towards price stability. A lot of the volatility in the market causes a lot of concern for many. Reason number 4 is a reduction in the federal budget deficit. I think this is the most important piece to getting lower rates in 2025. When the government reduces its budget deficit, it boosts the demand for US bonds, which pushes yields lower. As deficit rise, you have more issuance, which causes rates to move higher. Lower yields on treasuries will reduce mortgage rates because they're tied closely to these benchmarks. What needs to happen? Strategic fiscal policy, such as reducing spending or increasing revenues without stalling economic growth. And reason number 5, the spread between the 30-year fixed mortgage and the 10-year treasury. So during COVID-19, that spread between the 10-year treasury and the 30-year fixed mortgage rate widened to around 300 basis points due to all the economic uncertainty. Traditionally, that spread has averaged between 175 and 200 basis points. A return to historical norms could drop mortgage rates significantly, even if the 10-year treasury were to remain where it is today. So what needs to happen? Stabilization in the housing market and less risk priced into mortgage-backed securities. So these are the top 5 reasons why mortgage rates could move lower in 2025. But here's the thing, trying to time the market is risky. And remember, the lower mortgage rates go, the more buyer demand comes in. And that doesn't necessarily create a good environment to be a home buyer because more competition is going to cause home prices to move higher. The best way to take advantage of opportunities is to have a plan. Remember, mortgage strategy will always win over fear. So let's strategize together. And when you're ready to act and the time is right, reach out and let's make your goal a reality.